Good morning or good afternoon, depending on what side of the country you're on. Thank you for joining us. I'm Charlie McQueen. I'm super excited to be here with my co-host, Craig Cecilia. Craig, thank you for joining me today.
Good afternoon.
All right, so it's our mid-year economic update. We're about a day early. It's June 29th. I think tomorrow's halfway through the year, if I did my math right. But we're excited to be here with you today. So thank you for spending a bit of time with us. So we kick off again. I'm Charlie McQueen, president of McQueen Financial Advisors. I'm excited here because I have Craig with us, who runs our investment advisory division. I'm responsible for all the investment activity. Also here we have our asset liability management and CECL group and our valuation and transaction advisory group. So excited to have all three. Craig oversees our portfolio, around $13 billion of investments now, and does an amazing job with the credit team and the portfolio and alternative portfolio groups. So again, thank you, Craig, for joining me here.
You're welcome.
So today, just a little housekeeping here. As usual, if you have any questions, on top of your screen or bottom, you'll see a little bar that'll open up, and there's a little Q&A button. If you have any questions, please enter them in. We'll answer them along the way or at the end, depending on what is most appropriate. If you'd like a copy of our webinar, please feel free to reach out to your MFA advisor and they'll be able to get you a copy of it. It'll also be available on our YouTube channel. We're now YouTube stars. According to my daughter, that's a really cool thing. All right. So without further ado, we're going to kick off to the topic du jour. It would be inflation. This is a mid-year economic update, and we need to start with inflation based off of what's happening with inflation, and we'll get into interest rates and a number of other topics today. But definitely a lot has changed. I think, Craig, and if we look back at the amount of movement in the markets, we've not moved this much in 90 days that I can remember in quite some time.
It's monumental, actually. I don't think we've experienced it ever, and it's definitely impacting everybody. So it's here. The question is how long is it going to be here for?
Yeah, and it's thinking of changes here. Inflation, we haven't seen these numbers on inflation since 1980 or 2 or 84, depending on which number you look at. So it's been a long time since we've seen these levels of inflation. We're looking here at CPI up 8.6%. But it is down, you're probably going to point out, from the previous month.
It's getting better. So hold in there. You can loosen up your purse strings in a couple months because it's going to slowly get better.
Yeah, it's interesting. We look at the consumer price index and we look at it ex food and energy. One of the things that's really interesting when you look at the overall CPI, 40% is really related to energy prices, is the headline numbers you read and data you'll read. And, a lot of the effect, even when we look ex food and energy, if you buy something on Amazon that has no cost of shipping, it's clearly, someone's paying for the diesel fuel in that truck to get it shipped to me. So I know that energy is causing a lot of things here, and it's getting tough. And even the personal consumption expenditure core index is up nearly 5% right now. So some really big numbers for the Fed.
Yeah, we're hoping that drone technology for delivery takes off and reduces the cost of delivery so it doesn't get passed on to all of us here on the call.
I got it. So the battery-powered drones being fueled by gas-generated, I'm sorry, wind power. Yes. Okay.
Wind.
That's it. So the bottom price chart here was one that we've really looked at after when the Fed raised rates a couple weeks ago by 75 basis points. They did take us by surprise. We were expecting 50. There was a lot of chatter, though, that week about 75. And when the Fed chair says he's not going to do 75, that was our thought, why we'd stay with 50. But one of the things that came up was producer price index and how much the producer prices were going up. And that really set things off. This is the commodity index, producer prices by commodities, and it was really amazing. But a number of the reports came out. This is one of the commodity reports, but there was significant increase of producer prices. And you can argue both sides of this as we normally do, but we do see that producer prices, in my humble opinion, are an indicator of what may happen. And what I mean by that is when producer prices go up, the cost for me to produce a widget goes up. And so at that point, when I go to try to sell this widget, Craig has two choices. He can either buy the widget and pay more, and therefore inflation took place, or he can go, I'm not going to buy the widget, and just walk away. And that means business goes down. And so that to me is what really got the market concerned, was how much producer prices were coming up. And the outcome would either be less people buying things or even higher inflation.
Yep, well said. You know, in a nutshell, 'cause we do have the actual index on here, year over year, end of May, the final demand PPI was up 10.8% year over year from May to May. So that's a big number. That's inflationary. No two ways about it.
Yeah, huge number. And that's what concerned in the month. The monthly number was looking at going forward about 12%. I think it was 1% for the month. And so the last 12 months was that 10.8, which is a huge number. Either way, they're both big numbers. This index, we look at it, it skyrocketed. And this is the commodities. Obviously, commodities we've read a lot about, but they absolutely skyrocketed. They moved up as much in the past 2 years as they did 36 years. So huge potential for inflation here. Speaking of commodities, two of my favorite commodities would be oil and gas. I don't know why oil, except it's fun to talk about. The one I really use is the bottom chart here, gas. And what I've learned is that Michigan is not a friendly state, because I went out at lunch today and saw gas prices at $5.30. The national average is at $5, so we're above average, which is always nice to say. But this is definitely going to put a crimp on people's ability to live and spend money. So one of the things we did see when thinking about this was looking at the average cost of fuel going up for a family of four, and the price of food going up for a family of four. And family of four is important because you have to do a lot of driving for events and soccer games and activities, but we're looking at a combined increase of about $900 per month of expense to a family of four. Which is huge, especially when you compare to a mortgage payment. The typical mortgage payment on an American family before taxes and insurance is about $1,500 a month. So it's a substantial hit to disposable income right now, spending about $900 more a month on gas and food. This one's an interesting one. There's some positives here, right? Cars are still being sold on the bottom, and people are still building houses, but the house building number has really dropped substantially, with construction permits dropping quite a bit. Pretty tough to build a house when you can't get windows or shingles or garage doors or labor to work on that. Where did all the workers go, Craig?
Well, they're still around. You know, I didn't see a big population drop. So I think there's been a big shift of families that had a couple of workers in their household that shifted to one worker. And I think one of the catalysts to help encourage that has been the wealth creation, the paper wealth that is out in the marketplace. Even though we've had a stock market adjustment over this last few months, we still are well above where we were a few years ago. And then if you combine in household values that are just tremendous, which I can't remember if we clipped that out for this presentation, but that household wealth is huge, and people are looking at, they don't want to deal with this whole environment that we're in right now. And your job openings are just absolutely incredibly high. So worker shortage is going to be across all industries a big problem as we continue throughout the year.
Yeah, I do think this worker shortage issue is dramatic, and there's a lot of ways you can look at it, and we'll talk some more about that in a couple of slides. But it is definitely interesting, and that's causing some problems. And one of the things that does affect a lot of people in our industry is lending. And we're going to talk about housing and lending in a minute. But here, the auto sales number, which is really interesting. Jokingly, a friend of mine that works at General Motors told me that the inventory turn is 3 days. Now, this chart says 23 days, but it's 3 days because by the time the car carrier shows up, it takes them 3 days to deliver all the cars. Definitely a unique time frame, and the chip problem is going to continue. General Motors is publicly saying the chip problem is going to continue through 2024, 2025. So we should expect elevated values, maybe declining number of sales, just as they can't produce units. But it's definitely showing some of the supply and demand constraints that are really causing problems in the world right now. So how did we get here? I think it's an interesting point. We got here with money supply really getting messed up. And if we look back, we definitely should not have done as many stimulus plans as we did as a country. Easy to say in hindsight, but also since we're not elected officials, easier to say. But definitely we ended up with over 5 years of money supply growth in just 5 quarters. And so we have too much money, and that's what starts an inflation problem. Add on here COVID, causing all sorts of problems with delivery and trade. And then add a war. That doesn't help, especially when the war takes a major oil producer offline and also a major food producer offline, the breadbasket of the world being Ukraine. And then in the end, bad policy. This is a country, we were pretty darn close to energy independence. Some say we were, some say we weren't. We're right on the cusp of that. And then a current administration going after the oil producers on day one. Really a bad set of events that have all led up to this very unique problem that we're seeing. High inflation and this really supply and demand imbalance. Craig, do you see this inflation number here, which I'll go back a couple slides? Do you see this inflation number coming down or continuing to go up? I mean, what a great one to put you on the spot for.
Oh, absolutely. I appreciate that. So we're in a very strange situation, and I do see that we're going to have some continued moderation of inflation as we go throughout the year. Kind of going flat for quite some time. We obviously know there's a bunch of supply chain issues. There's a bunch of worker shortages, which we're going to talk about. But we do have some things that are correcting themselves, and you talked about autos and the chip shortages that we have. Well, there's thousands of cars on lots that are waiting for some chips, and that's still going to be a problem that doesn't get fixed. That doesn't get fixed till 2024 is what I think the industry experts are saying. So, yeah, we're still going to have elevated inflation, but I don't think we, fingers crossed, can't continue to go up at these escalated rates we're at right now.
Yeah, it's tough to go 8%, 9% one year, then another 8 or 9% the next year, and that is the fear. We're seeing it definitely in some rent areas we'll talk about, but it is the fear. And hopefully we'll see it start to moderate here, but it's going to be elevated for a couple of years. That's a summation of what you said there, correct?
Correct.
Okay. Well, with that, it is going to be interesting in our economy, but the result of this elevated inflation is rising interest rates. And so there's some big changes here, and this is the one where it throws, I think, everyone for a loop. You did say that was a good-looking yield curve back in 2012. Is this a good-looking yield curve today?
Well, it's a better yield curve than it's going to look in about a month and a half. So yes, how's that sound?
I love the foreshadowing. What's going to happen in a month and a half?
Well, we're going to have continued Fed rate increases. Is what we're going to actually have to their mandate right now. And as Powell has stated in his testimony, they're going to do everything they can to stop or at least ease up the inflationary number. And they think that it won't be at the risk of slowing down the economy too much. And that's the magic right now, is how can they soft land the existing economy when we have so much inflation going on right now? It's going to be a tough task.
Yeah, it's interesting. How do you stop inflation? Well, you get supply and demand into check. Well, by reducing demand, you slow the economy. And so it becomes an interesting issue. And so as they continue to raise rates, this is an interesting yield curve because it's actually starting to be inverted. We've gone from 25 basis points in the 2-year Treasury to 311. The 3-year Treasury is at 321. We go to 325 in the 5-year. But then we get to the 10-year, we drop down to a 320. So a lot of times you start to see this inversion. It's the market saying, hey, the Fed's going to raise rates. They're going to stop this inflation. They'll probably crush the economy. And I don't then need higher yields for a longer period of time because the economy will slow down and inflation will slow down. So a lot of foreshadowing in a yield curve right now. The timing of how long we get to that high point is probably the biggest question that I can think of.
Right.
So this chart is one of my favorites, as probably most of you know on the call. Red line is the Fed funds rate, blue line is the 2-year Treasury, and the black dotted line is the 10-year Treasury, going back to 2002 up until today. And it's really, really interesting to me when you look at this chart. It's really cool to me because we can see what's happened historically. If we look back here, while the Fed was raising rates in 2003, 4, 5, that was a good economy. Things were going well. People were really happy. We broke a housing market slightly, and then we had the inverted yield curve. Now, this is a seriously inverted yield curve. That's 0.5% or so between Fed funds and the 2-year Treasury and the 10-year Treasury. And then we fell out, and the Fed dropped rates quickly because the economy was failing. Now, if everyone remembers, in 2016, 17, 18, rates started going up, and this is what we call the normalization. The Fed was going to raise rates to a normal spot, so if there was a problem, they could reduce rates. And so we were trying to normalize the Fed funds rate, and then the pandemic hit, we came crashing down. But what you can see now, one, this is an extremely steep shift straight up. Number two, there is a big difference here between Fed funds and the 2-year Treasury. If we look back all along here, they were relatively close back in 2005, 6, and then 16, 17, 18, they were relatively close. Right now, we have this big gap, 1.5% gap between Fed funds and the Treasury. And what that's telling us is that either the Fed is behind schedule or the market is ahead of schedule. Which do you feel, Craig?
I think the market is a little bit of ahead of the schedule in anticipation of what the Fed's going to do. As you mentioned and alluded to, it's a big timing thing, and I do expect by mid to late summer we're going to have a lot of tightening between that Fed funds and the 2-year as they continue to raise interest rates. And the inverted curve that you talked about, Charlie, is certainly an indicator of somewhere over the next 18 months, give or take 6 months, we're at an end to this cycle, and it's going to start reverting itself a little bit. And that's why I say that's going to tighten up a little bit between the Fed funds and the 2-year.
Yeah, as the Fed raises rates, maybe this next month, 75 basis points, and maybe 50 basis points the month after that. We'll look at the projections, the betting in the Fed funds market. That would get these two pretty close together. And so I'd like to say the Fed's a little behind schedule, to argue with you a little bit, but I do agree with you. The market is moving a little faster than it probably should. And if you look at history here, we probably are going to see rates drift up another 100 basis points. 75, 50 basis points would be a high end. I'd start to feel, as we look at the 4% range, is a pretty high rate. One of the things I look at, how much does the Fed need to raise rates to stop this inflation? And if we go back to the 80s, because the last time we saw inflation like this was in 82 or 84, the Fed raised rates quite a bit. Fed funds rate hit roughly 20%. But to put it into relative terms, mortgage rates were at around 8%. And mortgage rates went to 16% in the 80s, 16, 17, 18. Here, coming into this, we probably should have been around 3.5% on mortgage rates, not all the way down to 2.75 in 30-year mortgage rates. I think that was a lot of the Fed buying down in the pandemic moments. But if we think 3% or 3.5% or 4% was more of a normal mortgage rate without all the Fed buying, we get to right now 6% on mortgages. It's not that much more. Get to 7% that we're doubling mortgage rates from where they were. 7 to 8% would double where normalized mortgage rates would have been. And so that's going to be a substantial effect on the economy, much like it did in the 80s, but we're just starting with a much lower number as our starting point. So interesting spot there. Now, speaking of that, Craig, you mentioned a moment ago, rates had skyrocketed, and this is just a quick picture of the 10-year Treasury and looking how much it's come up from June of 2020 to June of 2022. That's a big increase.
Yeah, we haven't seen this incremental increase in the 10-year Treasury before, and being down and when we've had an unreasonably low level on a Treasury at 54 basis points, I think is somewhere 53 basis points up to now. That kind of is the explanation of why it's jumped up so quickly. It was just a little bit too low for what our economy was taking place, and really not pricing risk into anything, quite frankly, with the amount of liquidity going on, and everything looked like it was going to be doomsday for the economy.
Yeah, a lot of money being thrown into the system at that point, and really causing it, so it was overdone. And now we're getting up to pretty good rates relative to where we've been. We did have a question come in talking when we were talking about inversion of the yield curve, and the question was, is the 2-year to 10-year inversion the one that matters the most? How would you answer that, Craig?
So the most commonly I'd like to say there's headlines and then there's technical numbers that we'll look at. And the most commonly look at is the twos to tens. And we did have a slight inversion there. But to go into a most probable predictor of a recession, you use a shorter treasury to look at that. The twos to 10 is a fabulous indicator, high probability of indicating that there'll be a recession within 6 to 18 months, but if you kind of look at, say, the 3-month treasury versus the 10-year, that's almost like a certainty of 95% probability of the recession coming. So it just depends on what you is most commonly talked about versus what is most probable predictor.
Cool. Thank you very much. Appreciate that. Well, speaking of predictions here, we have what's happened on the top here, which is the Fed funds rate going along. And again, you can see it come down in 2007, 2008. Then we flatlined until the Fed tried to normalize. Then we flatlined after the pandemic to now the rocket ship upwards. So we're at 175 in the Fed funds rate. And there's some pretty big predictions here. Now, these are the Fed funds futures, which is betting in the Fed funds market and where rates are going. We're looking at 75 basis points in July, then 50 in September, and then another 50 in November. But what's really interesting to me, December is flat, and February is only showing 25 basis points. So it appears that the Fed funds futures, which by the way they're usually correct in direction, they're not very correct in amount. But it's looking really interesting here that we're probably seeing a topping of interest rates projected in the Fed funds market at year end.
Yeah, that's exactly right. I really found it interesting. I looked at the board members' prediction of where they feel overnight rates will be, and it's actually not quite as high as what the futures market is indicating. So it's slightly lower to where the dot plot is what they call that, and the average is a little bit lower than that implied rate going out to 23, around that 350 rate. They're a little bit lower at 3.25, I believe, is where it's at.
So I think what we can take from this is that the Fed is going to raise rates here for the remainder of the year. Is it 50 basis points or 75 next month? That's an interesting question. I think we'll know a lot more the closer we get, and we're going to hear a lot of predictions for 75. We're going to have a lot of people calling for 100 or 50 even. So I think we'll be all over the place, and we get closer, we'll see it. But it is, I think, fairly reasonable to expect that we're going to get pretty close to 3% by year end in Fed funds. Do you agree with that?
Yep, well said. Right now, the market expects a 75 basis point increase on their next meeting, which is on July 27th. So we're gonna get up there pretty quick.
Yeah. So with that, something for everyone here in the call to think about how that's going to affect our institutions and what to do. It's also going to have effect on the stock market quite a bit. One of the things to remember is the Fed raises rates, most likely the rest of the yield curve will shift up for a little bit. And so we should expect a little bit higher rates. And then at some point, again, that inversion will take place and we'll see 10-year treasuries come down. But 10-year treasury is really interesting here because it really affects the stock market. Most of the dividend discount models all utilize the 10-year treasury. And so as rates go up, it's going to cause some havoc. And plus, as people's spending changes, it's going to cause some pretty big havoc on the stock market. So actually an interesting thought here as I look at the stock market. We're definitely seeing some modifications here. They've come a long way, Craig, but are they done falling? Do you want to call a bottom here?
It's going to get close. I think there's still a little bit of room to go down a little bit, Charlie. And why I say that is as we see an increase in interest rates, the cost of financing, the cost of debt can impact corporate profits a little bit. Each industry is different, and all of us on this call, the higher interest rates is actually beneficial for us for resetting on some of our variable assets. And we can talk a little bit more about that and what we do with our liabilities. But overall, that cost of business, that component, can impact the outlook on the stock market. And when I say there's a little bit more room to fall, I'm not talking another 20% or 15%. So there's room to come down another 5 or so. Yeah.
It was interesting. As you were talking, I was looking at that NASDAQ chart there, and The Nasdaq had a good run up to nearly 10,000, round numbers, Charlie math here, and dropped with the onset of the pandemic, and then came roaring back. And it's really interesting. It went from 10 to 16,000, so up 6,000, and now we're back down to about 12, we'll call it ish. So we've gone from a 10 to 12, so only a 20% increase now over the past 2 years. So that's, you think of it that way, it's still up quite a bit, even though everyone's unhappy about it. So I do think it has some room to come down also. Well, talking about that, we get into housing. Why do I want to get into housing? Well, as Craig mentioned a second ago, payments start to matter and how people invest in excess funds. And interesting numbers that came out. And last time we did this presentation, we talked about some different rent dollars in different cities. But rent costs in the United States, on average, jumped 14% in December of 2021 compared to December of 2020. And in April of this year, the median monthly rent cost hit a record of $1,800. So the average or the median cost of rent is $1,800. So we've seen this come up dramatically, which has really hurt people's ability in rentals. Also justifies a little bit higher home values too when comparing your mortgage payment or a mortgage payment to a rental payment. So some really interesting numbers that do cause some painful inflation and give people reduces their ability to buy other things.
Yeah, that's a big number, a big line item for our household balance sheets, that's for certain.
Yep. Well, now, you mentioned earlier a little bit about home sales. We are seeing home sales start to slow a little bit, net sales, but we're still seeing overall price indexes up. Really quite an interesting spot here. I know supply and demand is really hurting the housing building market with inability to find people and material. But we're also starting to see used homes or existing home sales start to come down a little bit. This trend is definitely going to continue, and we'd expect it based off of mortgage payments. Today's mortgage payments, a brand new 30-year mortgage with 20% down is roughly 6%, just a little below it. I think it was 585 this morning when I looked. So that's up substantially from the 3 range. So we're probably going to see a continual slowdown. But one thing we don't want to forget, there's substantial demand. A lot of millennials that have reached home buying age, a lot of people looking to downsize and move. Even though the economy is different here, I do expect that we're going to continue to see some okay housing activities. It's not going to be like 2008 would be my 2 cents. What are your thoughts there, Craig?
Yeah, we just have an entirely different economy for that supporting the housing market right now with the supply demand issue and that wealth coming out. But those mortgage rates is really all but dried up the new purchases, or I'm sorry, the refinance market.
Yeah.
And an interesting thing for everybody on this call and product wise and deliverables is we've seen a slight increase in ARM product and home equity product as everybody has these home values with low loan to values. So there is products out there that's really working for a lot of the people on this call today.
Yeah, it's interesting to me. I think that obviously rates have come up, made things not very affordable, which should push your ARM production. And then if you think about it, if I have a 3% mortgage and I want to add a bathroom, I don't want to redo my mortgage. I most likely want to go down the path of doing some sort of second mortgage or a fixed home equity. So interesting stuff there. We still have a lot of homeowners who lived in their homes for a long time, so there's still going to be demand to move. We've looked at this chart a few times. And it is interesting. We are beginning to see that change in the housing market. We're down to 5.4 million, which is, down, but it's down from 6 million, which was a record on an annualized basis, pretty close to a record. It was the fastest pace in 15 years. Existing home sales declined 3.4% from April to May. And you get affordability. Usually this is when the market starts to heat up, and because it's the time of year to move. But we did continue to see this affordability issue. Median home sale prices hit $407,000, the first time they've ever been over $400,000. So some really, really big numbers here. What is interesting, we're seeing home prices rise. At the same point, we're also seeing inventory rise. So probably not a sustainable activity to see inventory rise and home prices rise. Now, inventory did move up a bit, but it's now only 2.6 months. It was about 2.4. So it's improved, but that's still a really, really low number. Some would say not a very healthy housing market. or very healthy if you own one. Is that probably a better way to put it?
I think that's a better way to put it. Absolutely.
Yeah. All right, auto sales. We talked briefly about this on a slide, but I think here one of the key things though is what happens to the consumer, and and what the consumer can afford with the car prices and where we are. One of the ways that the consumer does really well or really poorly is if they have a job. Really interesting. When you have a job, life is really good. What I can say from this next set of charts, Craig, is that if you want a job, you can get a job. Is that an accurate statement?
If you're willing and able to work, there's a job out there for you. Absolutely. The problem is the willing part. Well, we still need to work on that participation rate a little bit. Get people back that are comfortable staying at home and out of the market for the time being.
The labor force participation rate, which is the top graph here, it's looking much better. I mean, we were up around 63 and 3/4, and then we fell apart to 60. Now we're back into 62 and a quarter-ish, 62 and a half. It's improving, but it's got a ways to go. Do you ever think we'll see this get back up to 64%, 63 and a half?
I think it should slowly get up there as we get back to a normalized rate. I do think that this inflationary market has some consequences, right? We've already talked about the negative ones, and some of those negative consequences will cause people to want to go back to work who have left. We've had a lot of not elderly, but older people that have left the workforce. And I think that some of them will want to come back once they start to truly feel the elongated effect of the inflation that we've been experiencing.
Yeah. We get people back. That would be a great thing, and unfortunately, if it's based off of having to live, that will get there. The bottom chart here is really interesting to me. This is the unemployment rate. We have job openings, effectively have involuntary job separations, job hires, offers, and then job openings, again, as I mentioned. This is the big one. There's still a ton of job openings out there, and not a lot of room. And so I think there's going to be continued demand that takes place. And if we look at the next slide, the unemployment rate here, it is really looking good. We're here down to 4.3% in Michigan number here, with 3.6 nationwide. We're seeing the length of unemployment really start to decline. We're at pre-pandemic levels, and so it's truly been an amazing modification that's taken place. With this, when you have a job and the government's giving you a lot of money, you can save a lot of money. And we saw here the consumer really skyrocket their savings rate. A massive amount of savings happened during the pandemic, but what's going on now?
We're starting to see the reversal of that savings rate as the money is starting not to be given away, right? That kind of all stopped, and we're starting to see that rate come down, affecting us on this call and all of our clients, not all of them, but a majority. We're starting to see that liquidity growth that got poured into the economy and the ballooning up balance sheets is just slowing up now. It's not growing as at all, really. It's kind of flatlining now.
Yeah, it's interesting. People are going to be, and I think this number is going to continue to come down quite a bit as gas prices and food prices is really going to take a bite out of people's ability to have savings. And we might even get back to 2%, 1%, and see this come down quite a bit. That'd be a really big move. As you see here, since 1960, we've been consistently positive, and we're getting back down to some of the low levels we saw in 2005, 2006.
Mm-hmm. And that kind of translates into opportunities, right? Good numbers, bad numbers, but the lending opportunities will continue to start to increase as people's saving rates go down. People will be chewing into their savings, and they'll really want to continue to borrow.
Yeah, and that's interesting. We've seen a decent pickup in borrowing right now, so it's starting. So it's a really good point. Well, one of the things that's going to make this different, people say to me, well, if we do go into a recession, which we haven't talked too much about the impending doom of a recession. I mean, we did have 1 quarter of negative GDP growth, which we'll talk about in a minute. When you get a couple of those, you have a recession. So we may be in a recession, we may be in a downturn. It's definitely a slowdown of some types. But one of the things that's going to make this very different from the last time around, and this won't be like 2008, It's just we're coming into this with good inflation, meaning if you lent Charlie $100,000 to buy a house, that house is worth $200,000 today. I'm not going to walk away from that house. I'm going to keep it because, frankly, the mortgage payment is low with interest rates compared to values in mortgage rates today. At the same thing, if you think about cars, why would I walk away from a car today? My car is worth more, and I probably won't be able to get the same low interest rate. And so we're going to see consumers actually not default nearly as much as what people think. And this is what the delinquency chart's showing us. This is delinquency on all credit cards and all loans, or on all credit cards, excuse me, on all credit card loans. And this is the one that usually shows up really fast. And here we are at super low delinquency, below 2%. Now, we are seeing some comments from GMAC talking about some of their low credit car loans delinquencies going up, losses are not going up. And the office real estate market, we've seen some pretty big foreclosures take place in primarily Chicago and Los Angeles and San Francisco market spaces, a little bit New York, but we are definitely seeing some of the large office spaces start to go delinquent a little bit too. So with that GDP, as I mentioned a second ago, you know, we're cooking along here, and it's cooked into a -1.5. Or what is it, Craig? Two quarters and we have a recession. 3 quarters. How's that all work?
2 quarters contraction is defined as a recession. It'll be an interesting quarter as we come in. We're not expecting a recession this early because there are still some positive things taking place, some growth in the marketplace. We obviously have a lot of headwinds with some of the things we've talked about with supply chains and people and just you know, inflation. But two quarters in a row would be a recession.
Yeah, so it's definitely potential there. You know, what's the difference between a recession and a downturn? Well, in a downturn, you lose your job, and in a recession, I lose my job. So I think that's the true definition, right? We did have a question come in. An attendee asked questions about where we're seeing wealth increasing. Everything they've seen is wealth decreasing for Americans, especially home buying age. And it's interesting. So wealth increasing and the charts and things we're showing here, affordability is definitely decreasing, which is going to reduce savings rates. And where we've seen wealth increase overall is because from the people that do already own assets, homes, investments over the past few years. I mean, we're still 10 to 20% up if you go back compared to 2 years ago in the stock market. So wealth is higher. Now, it has come down from the peaks, but wealth is still higher for most people where they are today. So that's where we're getting that data. Really interesting stuff. So we're going to skip that page. We got a new one coming out. I'm really excited about with some new interest rate projections. But I wanted to spend a couple minutes here to talk about, you know, what should we be doing with this data? As Craig's pointed out here, we have a potential to be in a recession right now, maybe a downturn. We're going to have continued inflation, a little bit higher interest rates. We're going to have the Fed raise rates. You know, what do we do as a financial institution with what's happening in this area? So to me, this is really, really interesting right now. So with that, we'll kick this off. Balance sheet management, one of the most important things out there. And when we enter these environments with these significant modifications of interest rates, making sure you're looking at your ALM reports, you're working on strategy, and you're working on some good decision making when you make changes. People talking about modifying rates, modifying offerings, make sure you're running it through your balance sheet to make sure you understand what's happening. As Craig said, one of the biggest things we're really seeing is some good lending still taking place. It's really quite interesting to me. Consumer lending still going well. Mortgages, not as many purchased, definitely no refinances. We are seeing more ARMs and some second mortgages take place. You seeing anything different, Craig?
No. The amount of auto lending which is not everybody on our call today are in auto lending, but that has just been off the charts as of lately. And imagine if we had enough supply where those
Yeah.
numbers actually could be.
Yeah.
um, and commercial as well. There's a lot of needs out there. There is sector within the commercial lending space where you have to be careful. We're worried a little bit about office, as you could say, they're struggling there, but the opportunities are really doing well, and institutions that have the liquidity are taking advantage of that and really growing their loan balances.
It's interesting. It's definitely a good time. Which, remember, if we go back to the chart where we're talking about rising interest rates, and my favorite chart, as we talked about a minute ago, when interest rates are rising, when Fed funds is rising, it is a good economy. It is a good economy for all of our clients, everyone on the call here. Loans are more plentiful. Deposit rates still stay low. Margins are improving. Investment portfolios are resetting. And on top of that, we have low delinquency, and we expect to continue to have low delinquency. All those things combined really show that for the next, is it 6 months, 12 months, we should be in a pretty good economic environment. We should do really well from a standpoint of our banks and credit unions on the call. That should do well. Is it going to get tougher for consumers? Absolutely. Consumers are going to struggle. They're going to have higher expenses on dollars going out to gas and food. And so they are going to borrow. And so that's where this is a great spot to be. And one hopes that we can figure out some of these gas prices and food price issues. And I'll make fun of our elected officials. They're going to want to get reelected, so they're going to work really hard to reduce these costs so they can get reelected. All that being said, one of the things that does make me a little nervous is some of the cost of funds. We're starting to see some people make some pretty good moves on cost of funds up. It's a tough spot. I mean, Craig, what are your thoughts? Should we keep those rates low as possible for a while?
I think that deposit rates are going to have some upward pressure, and we haven't hit the time where we have to make deliberate actions. It really has to be based upon each balance sheet need in your market for you and whether you're moving them or not. A delay, a lag, if you will, is definitely a positive for most everybody, and kind of necessary, quite frankly, so we can get a little additional margin into what we're trying to accomplish to ensure that our net income remains the same, or net interest margin remains the same.
Yeah, minimum is the same. I'd love to grow it. And, it's interesting here. I agree with you completely. And it's, as we think about the business we're in, it's a margin business. That's a vast majority of our income. And we've been in this really compressed environment for a long time, where we had loan rates down, investment rates down, and deposit rates are at the floor. So we want to allow them to come up a bit. We want to drag our feet. And frankly, we've also, had a ton of deposit growth. I don't think we're going to get much more. And one of the things here I threw in this chart of deposit growth during the pandemic, 5 quarters we went up and skyrocketed, and that was worth 5 years of increase. And that's a huge amount of deposit increases. And so now, as we think about what should I expect for my deposit growth for the next year, probably very little deposit growth. I would expect that we're going to see consumers spending money. We probably are going to see deposits even decline a little bit at our institutions or stay flat. I wouldn't expect to see much growth at all. Again, because of the prices of commodities, gas, food, and all those different components. So I do think, and a question just came in that, do we expect share runoff due to higher inflation and gas prices? And I'm not going to say runoff. It's because people think run, and I think that's not the word we want to use. Do I think we're going to see some pressure on deposits? Yes. Do I think we'll see deposits go down in some institutions? Absolutely. We also have to remember we're entering the normal spending cycle of the summer when people are spending money and they're going out. And so if you are seeing deposits go down a little bit, that's very normal. I don't think we're going to see a massive runoff, because I think there's going to be a lot of people not putting money into the stock market and retaining it in their checking accounts and money market accounts at this point. But it is going to be a challenge. And again, I'd expect zero deposit growth for the next few years. Craig, any thoughts on that?
Nope, I agree with that entirely. And I think there might be some contraction as well, but definitely not growth.
Yeah. Another question that popped in while we were talking a minute ago was looking at housing prices and going back and asking, when will the bubble burst? And it's an interesting question, and because it continues, we can't maintain double-digit home price increases, and I agree with that. You can't maintain double-digit home price increases. It doesn't work. Affordability falls apart, especially with higher interest rates. Definitely causes a lot of problems. So how I'm going to answer that is, I saw a house for sale, and it was listed for $200,000. Someone bought it for $200,000. I thought it was worth $150 when I walked through it. They relisted it for $250. Someone bought it for $250 and has now relisted it for $350. And the house has been sitting on the market for about 12 months. So that house is going to go from a $350 listing price. Someone's going to say it gets cut in half down to $150. And yes, so that house will drop by 50%, but there was speculation in that one house dramatically. Most houses we see have not realized, people have realized that gain and have not seen the big amount go up. But overall, homes are worth more when there's a scarcity value. I think we definitely see a trend of them not going up in value. We might see a reduction of value, but 5-10%, not a 50, 60, 70% type activity that we had in 2008.
No.
All right. From there, lever number 4, something really important here is making sure that we go down this non-interest income side. Everything we've talked about today has really been about margin and growing that margin and where we're going with this economy and how we can get more loans and how we control our deposit costs. One of the other things to pull along and talk about here is we will see tougher activity a couple years down the road. Maybe it's 12 months, maybe it's 18 months down the road. And then we get an inverted yield curve and we start to see things go down and potentially get some loan losses and maybe have some of these homes that are a little overvalued or office buildings. What can we do to continue to make sure that we have a good income stream to continue to grow equity? And that's another component here. We had so much growth in balance sheet dollars by the deposit growth that equity numbers are low relative to asset size coming into this type of environment. So making sure we're looking at ways to grow that. We've been talking about this for the past year now. We've been talking about investment services, SBA lending, insurance sales, debit cards. All those things are great to add on. Mortgage sales is still on here. Once again, people are going to continue to buy homes and they will start refinancing at some point, not as much for a long time, but one of the core things people do is going to be buying homes. So I want to be definitely working in that area. All right, we'll flip to the 5th point here. Craig, this is near and dear to your heart. I think this is something I'll throw to you, but man, I don't like negative convexity today.
No, it's a good conversation to have with everybody. And when we're talking about investing correctly in order to take advantage of the current economic environment, rates are high, and put it in simplest terms, when we're booking assets in a higher rate environment, we want that asset to stick around as long as possible, especially since what goes up must come down when you're referring to interest rates. So when you're talking about duration and convexity in a higher rate environment, it really is important to match and your balance sheet, and for you to have the ability to put on certain durations. But if you can afford it, if your risk position can handle it, going out longer as rates are rising is a really good idea. And we really like to make sure that they don't have that negative convexity where that, simply put, that asset can disappear. The issuer of a security or the borrower has the ability to refi or pay off where it goes away, and then we're stuck reinvesting in a lower rate environment when that actually happens. So it's really important to look at that in that curve. And a lot of people will think about the shape of the curve. Charlie, you talked a lot at the beginning about the steepness between Fed funds and the short-term rate. And after you get past 2 years, it's very flat. And you look at the incremental benefit right now of going out some 2 years to 5 years to 7 years, it doesn't appear to be But under a lot of rate environments, meaning 2 out of 3, you're going to do either okay or better if rates remain the same or go down eventually. And if rates go up, yes, you could have reinvested and when it rolls off. But we like to take advantage of higher rates because we will have a rate reversion down the road. Even the people that are predicting Fed funds to go up more, there is an inversion where they show that futures are showing rates coming back down in 2024 and longer. So that's where we like to lock in some of these higher earning asset yields and not trying to predict exactly where the top is.
Hey, well, very well said. Because if you look at how long the top has been in 2006, 7, and 18 are here, we historically, and we can go back to the previous rate cycles, they look very similar, where we hit that top for a very short period of time and then come down. So you either have to figure out when we're at that top and have every investment come due and reinvest to do really well in this declining environment, or as rates go up, if you continue to invest the correct duration, and as you peak out, your portfolio will really do well when rates come down also. And so remembering, it's very, very hard to pick the day that's the top. And what you want to do is make sure you're looking at it throughout a big picture lens and thinking long term. And that's where, convexity is a big thing. I don't want our money coming back at the wrong time. Negative convexity means as interest rates go down, everything can pay off and come back. And as interest rates go up, everything extends out. And we want to limit that. Something really important. And then credit, how's everything looking on the credit front right now?
Right now, credit's looking really good. On the municipal front, we've actually been seeing actual upgrades, continued upgrades, and that's kind of more of a delayed financial release cycle because they only typically issue annualized financials. We're not worried in that space, but in the corporate world, we do see some good corporate profits. But as we talked about a little bit earlier about higher interest rates, the stock market, they could impact some sectors. And high interest rates, you can see, really impacts the tech sector, for example, because it gets very expensive for them. But so we're keeping an eye. You have to be very deliberate in your purchases. One of the things that we have seen is a widening of corporate spreads. So when we had that liquidity and that low and long and low rate environment there for between 2009 and 16, corporate spreads really tightened to where there really wasn't an advantage, or at least you weren't getting compensated for the risk that you're putting onto your balance sheet. Now we're seeing it widen, and that's a component of two things. One, liquidity going down in the market, so less demand, and then also just the outlook for earnings for the corporations, as well as things become a little bit more tedious and margins start to get potentially impaired.
Yeah. Yeah, I think it's definitely going to be interesting here. And again, we go back to the price of goods, and if companies can continue to sell them at profitable margins, and that's really going to potentially put a negative impact there. Well, a couple questions that just came in. What are your thoughts, assuming liquidity gets very tight in a strategy of short-term, excuse me, repeat that. What is your thoughts, assuming liquidity gets very tight in a strategy of short-term borrowing to cover needs versus raising deposit rates to increase liquidity? So the question is, should we be doing short-term borrowings versus raising our deposit costs at this point?
It's a really good question. And one of the things I want to point out, we've had this conversation over the last few months actually with clients, is don't be shy of raising loan rates. You're still going to be booking those loans. And we don't need to necessarily hold loan rates where they're at and to get the volume that we maybe haven't been getting or have been getting and can have been easily funded. Raise the loan rates. That'll make this funding decision a lot easier, right? We're okay with raising deposit rates if you need them to fund good earning assets at good market rates. Now is that opportunity to make sure that that balance or maintaining that net interest spread is there. And actually try to grow it, because over a long period of time, we kept seeing the spreads slowly come down, and because we couldn't lower deposit rates any lower.
I think that's a great answer. And one of the things I always think about too is even if you raise rates, will you get more deposits? And do people have more deposits to give you? And that's an interesting thing. What is it going to take to attract new deposits? So as you think through all that, I do think that it's something that I would work carefully at, of gently raising deposit rates, doing borrowings, structuring some borrowings. I wouldn't go too long on borrowings. If you do go long on borrowings, look at maybe doing some puttable advances where you have the right to put them, some different components there. Another question that came in, Craig, this one is one I'm going to throw to you. With the investment portfolio not being able to be sold due to excess unrealized losses and deposits remaining flat, liquidity is going to become an issue to support loan volume. Do you have any recommendations or suggestions to assist with this?
Right. I think as I listened to that question and the prior question, they're very much related. Because for the second question is how do I raise that liquidity if I can't sell my securities? It goes down to what do I have in my existing portfolio to pledge to as a collateral to a borrowing facility if you're not outright borrowing. The other is having a blanket against your residential mortgage portfolio of all mortgages as a pledge as well to create that. But ultimately, it's what is your cost of funds and what would you have to raise it to have your market, your membership fund those deposits versus wholesale borrowing, either through broker deposits or through borrowing through a Federal Home Loan Bank.
So it's a great question. It's a tough one. I think a lot of people are going to be facing. And one of the things when you look at liquidating securities, make sure you're looking at the borrowing costs today and borrowing costs predicted, and understand the differences and the balance sheet size differences and leverage differences and the equity effect. So there are a couple things to do there. You'd really got to dig into the numbers is really the answer. Again, understanding your borrowing cost, understanding the yield on investments, and then understanding your borrowing strategy. Because all three of those might be what we need to do. And historically, when we've gotten into tougher liquidity in markets, we've had to do all three: sell some investments, borrow some money, raise some, maybe look at some other transactions to make it work. So with that, really want to thank everyone for joining us today. Our next webinar is going to be on July 28th. I'm really excited about this. Our new ALM online simulation system, it will be demonstrated. I'd love for all of you to come and take a look at it. All of our clients out there, you'll be receiving a link yourselves directly to go in and start using it. We're super excited. A lot of work's went on this team and our entire team, and we're really excited to release it to the world. And so if you'd like to go, please go to the website, click on the webinar section, register, or send an email to Kaylee and she'll get you registered. With that, Craig, I really want to thank you for your expertise and time. We're definitely seeing a unique environment here. We're going to continue to see interest rates rising, the Fed raising rates, inflation being high. None of it sounds really good, and I sound really depressed when I give that presentation at that point, but thinking that we are going to see some positives here. We're going to see a good economic environment for the next 6 months to 12 months. As you mentioned, loan volumes are coming up. They're doing well. We're going to continue to see some good loan volumes. So it's going to be okay. We're going to make it through it. Our margin's going to improve, but it's definitely going to be a challenge.
Absolutely. You're welcome. Thank you for everybody participating today. And the questions, the Q&A session always helps enhance our webinar. So we really do appreciate that as well.
Thank you very much, everyone. Have a great rest of your day.